This is Seth David from the world-famous Nerd Enterprises Incorporated, bringing to you another special screencast. This time we're talking about understanding the statement of cash flows. Knowledge is power. Make an impact by learning more. Call me right now at 866-945-8070 for information about private trainings. We record the live session with you so you can review it as often as you like afterwards. Hi. Okay, very quickly before we get started on the statement of cash flows, make sure that you come here to the events section of my website and then scroll down on the page because you're going to look for the cash flow projections event. And if it's before the date, then sign up for the live event. You'll get the recording even if you can't make it at that time. If it's after the date, there'll be a link here which you can click on in order to pay for and download the recording of the live session, which will review how to do your own cash flow projections, and of course requires your good understanding of the profit and loss statement, the balance sheet, and the statement of cash flows, which is what the purpose of this and the last few screencasts has been. So if you're missing those, just go into my YouTube channel and look for the playlist on understanding your balance sheet, understanding your profit and loss, and understanding your statement of cash flows. Review those videos and then get this download and go through the session. It'll teach you how to develop a great tool that you can use for analyzing and projecting the information about your business or your client's business, if that's the case. Now let's get into this. Let's take a look at the beginning of the statement of cash flows. And of course I've got a sample company file here, and we're going to take a look at what this looks like. Now we've reviewed up until now the profit and loss so that we have an understanding of what this financial statement looks like and how it works. We reviewed before that the balance sheet, so we understand this financial statement and what this looks like and how it works. And if you've read the blog post for this particular video, then you've read what I've talked about, which is that the statement of cash flows, in order for you to understand it, really requires that you understand what's going on with the profit and loss and balance sheet. For starters, it's a reconciliation of the net income from your profit and loss to the ending cash balance, which can be gotten from the balance sheet. It's the total of all your bank accounts. And also the way QuickBooks works, it includes the undeposited funds account. We'll get into that during the live webinar in terms of talking about why sometimes the QuickBooks statement of cash flows will actually differ from the balance sheet's total cash balance. It's based on the undeposited funds account. And so I'll talk about that for a few minutes during the live webinar. But let's see what this looks like. Right now, as you can see, I've got these two financial statements run for all dates. And there's nothing in here. It's a brand new set of books. I haven't done anything with it yet. And if I run my statement of cash flows, which you can do, by the way, in reports and under company and financial, it's way down at the bottom. Maybe that's why nobody ever notices it or pays attention to it. Or maybe it's just because they don't understand it. So I'm going to help you understand it. So that's how you can run your statement of cash flows. And notice, of course, that this is also blank. There's no transactions recorded on these books yet. So let's record a transaction. Let's record an invoice to show some income and keeping. And this is why it's so important to understand the relationships between all these statements. You have to understand when I record an invoice, and we're doing this on an accrual basis, because no matter how you pay taxes, your business functions on an accrual basis. You're posting invoices and receiving payments on them later. You're entering bills and making payments on them later. That means your accrual basis. The only way you're truly cash basis is if you don't even record a transaction until it's been paid for. And that's not realistic. Obviously, we couldn't run a business that way. So no matter how you pay taxes, every business functions on an accrual basis, and it has to be analyzed and looked at from that perspective. So I wanted to make sure that point was clear. Clear? Okay, good. Glad we got that straight. Now, let's take a look at what happens when I post an invoice. Two things are going to happen. We're going to affect the profit and loss on the balance sheet, right? Because I'm going to post an invoice which recognizes income, and I'm going to have accounts receivable go up. Now somebody owes me some money. So let's post an invoice, and we'll set this up for Always Right Incorporated, because the customer is always right. Isn't that what they say? We can get rid of this summary. Let's just create a quick service item here. I should have done this ahead of time before the recording. We'll just call it services and hopefully spell it right. And over here, the sample company file I chose, I just used a template for an accounting business. Obviously it's not, it doesn't really matter. So let's say we're billing somebody $2,500 for our services, and of course we're going to see what this looks like on the P&L and balance sheet. So we've got our balance sheet here. Sure enough, shows my receivables, and sure enough, I have my income on the profit and loss for $2,500. Now, keep in mind there's no expenses on the books yet, so my net income is just the $2,500. My accounts receivable is $2,500, and then of course that $2,500 net income flows into the equity section of the balance sheet so that the balance sheet balances. Let's see what the statement of cash flows shows about this. And it's interesting because in the blog post I mentioned this. It's very important to understand. The statement of cash flows reconciles net income to cash, and what's in between are fluctuations in your balance sheet account balances. It's not the account balance itself, it's the fluctuations in the account balances, and then something is done with that to show, based on that fluctuation, how we get from net income to what's in the bank at the end of the day. Now, how much money do we have in the bank? Look on the balance sheet. It doesn't even show the bank account because there's no cash. We haven't received any money. So what does this do? It says we take the net income and we show we have an increase for the period to accounts receivable. Accounts receivable has gone up by $2,500. But since we haven't received that money, it has to be subtracted from net income to arrive at what cash is in the bank. There's no cash in the bank, so our cash at the end of the period is zero, and it reconciles the cash. It says we start out with net income of $2,500, and the owner of the company says to me, so since I made $2,500, why don't I have that in the bank? I answer the question by running the statement of cash flows and saying, well, look what happened. The accounts receivable increased by $2,500. Therefore, we have to subtract it from net income to arrive at what you have in the bank, which is zero. The reason you don't have any money in the bank is because you haven't received it yet. Now, this is a very simple example of how this works and what this looks like, because there's only one transaction on the whole set of books. So now let's go receive some money for this and see what that looks like. So the first thing I have to do is create a bank account real quick. So let me do that. Create the new bank account, iBank. So I have somewhere to put the money when I receive it. And now let's go to customers, receive payments. Where are you? And because this is a brand new company file, QuickBooks is forever trying to sell me stuff. So always write incorporated, pays us $2,500. Save and close. Now, as you hopefully know, this money is still not in the bank. It goes into undeposited funds. So we just moved it from accounts receivable to undeposited funds. I don't have it in the bank yet. Go to the statement of cash flows. Now look what happens. The QuickBooks says that we now have this money, because the way it treats undeposited funds is the same as cash, even though it's not in the same section on the balance sheet. So, of course, if I go deposit the money, there's going to be no change here. But notice what we have. We have net income. There's no change to accounts receivable anymore for the period, because accounts receivable, even though what happened in between is it went up by $2,500, then it was reduced by $2,500. Since we're reporting on the period for all dates, it looks at this as no change to accounts receivable, because at the end of the day, accounts receivable got back to what it started at, which is zero. So no change means nothing shows up on the statement of cash flows, even though in between it did increase and then decrease by the $2,500. Now, if we look at the date that we received this payment, I can double click my undeposited funds, October 5th. If I run the statement of cash flows based on 1/1 through October 4th, we didn't receive the money yet. What was the date of this? October 5th, 2011. Problem is, everything else is booked on October 5th as well. So let me back the invoice date up, just so you can see the impact here. Let's say the invoice was dated September 1st. Now watch what happens. Now, if I go to my statement of cash flows as of October 4th, we see what we saw before, which is that I had my net income and I had my change to accounts receivable. Accounts receivable went up, which means we have to decrease net income by that amount to arrive at what we have in cash. And over here I've got my undeposited funds, because again the statement of cash flows is now run just through October 4th. So if I change this back to all dates, then we're back to where we were. So I want to make sure that point is clear. Now let's take a look at what happens when I invest money into the company. So let me go to banking, make deposits, and let's say that actually, first let's deposit this customer payment so it actually sits in the bank account on October 5th. Get that out of the way. No change to the statement of cash flows, because again, QuickBooks looks at undeposited funds the same as cash. now we've got that money in the bank account. So let's go make a deposit, and let's say we're getting the bank account started with $10,000 to get the business going. So let's say that as of 9/1/11, we deposited $10,000. Now, I'm just using opening balance equity because the main thing for now, for this purpose, is to put the money into the equity section of the balance sheet. You would normally put shareholder contributions or something comparable along those lines. So when I save this, of course, it shows up in the balance sheet in the equity section. Nothing happens on the profit and loss because all we did was put money in the bank, and it represents a contribution into the business, so it goes into the equity section. But look what happens on the statement of cash flows. Now we have $10,000 that we increased the balance with. So we have to account for that, and it's not in the net income. So what happened is we had an increase to equity. Increases to equity represent an increase from net income to arrive at cash. So if I added money into the business, that money is not included in net income. So I have to add it to net income to figure what I have in cash in the bank. So that's how we deal with something that went into the company that didn't affect the profit and loss. Now let's get a loan from the bank. So let's just say the bank just loaned us $15,000 on October 1st. Loans payable. We'll just call it something good and generic like that. Save that, and let's say $15,000. So the bank just loaned us $15,000. Now I have more money in the bank. I have my loans payable. Again, nothing happened on the P&L. So again, on the statement of cash flows, I'm going to have to account for the fact that I just put money into the business that isn't reflected in my net income number. Notice net income hasn't changed. I didn't earn this money, I borrowed it. So let's go to the statement of cash flows. And by the way, that phrase I just gave you there, the fact that I didn't earn it, I borrowed it, is kind of a clue into how in next week's webcast we're going to take a look at really what the statement of cash flows is telling us about how the company's performing, where the cash flows are coming from. So that's a little bit of a hint and a sneak preview. But look what happens. Now I have the loans payable, again, has to be added to net income to arrive at cash. Now let's pay down some of the loan. Let's say this is really a line of credit, and so I go in and I write a check, and forgetting about the interest, I won't even bother getting into that for this purpose, but let's say I write a check to the bank for half the loan, $7,500 I repay. Of course, I book it to loans payable. Look what happens on the balance sheet. Of course, my loans payable goes down, so does my cash, right? Because I took the money out of the bank to pay off the loan. Now look what happens here. Now, notice what happens. The net on the loan is that I have effectively borrowed now $7,500 during this whole period. That's the net change to the loans payable account during the whole period, because I borrowed $15,000 but I repaid within the same time period $7,500, so I'm left with a loan payable of $7,500. So that's what's sitting in my bank balance that has to be added to net income to arrive at the cash balance at the end of the period, which again is $20,000. So hopefully this gives you some idea in terms of understanding how the statement of cash flows works. It looks at the net change, the delta in an account balance, which has to be either added to or subtracted from cash, or from net income rather. It has to be either added to or subtracted from net income to arrive at what we have in the bank today. And the way to understand this is to think about what happened, what is not included in net income, and how does that affect our cash balance, or how does it not affect our cash balance, such that we can use this information to figure out what we really should have in the bank. And that's how you want to think through what happened on the statement of cash flow. So if I invoice somebody, my accounts receivables go up. That number is included in my net income, but I haven't received the money for it yet. Now, it's easy to understand when you're thinking about it in terms of just one invoice. But what's important to understand is conceptually that when I'm looking at this and I have a real business that's in operation, and I have hundreds of invoices that I've produced, and I receive payments on some of them and not on all of them, then what you're looking at on the statement of cash flows is what's the net change to accounts receivable for all of it. So if I've invoiced in total $100,000 to customers, and I've collected $75,000 of that, then the net change, and then I have to look at what was the accounts receivable balance before that period to see what the net change is. How does accounts receivable before the period I'm reporting on compare to what it is as of today? And if I can understand that, then I can understand what happens on the statement of cash flows. Because let's say I started with 0 accounts receivable, I invoiced $100,000, but I've collected $75,000, then my net change in accounts receivable is going to be the difference, or $25,000. So that's what's going to have to be subtracted to net income for accounts receivable purposes to arrive at cash. And understanding the difference between these types of accounts and how they work is going to be critically important in terms of understanding how to put together the statement of cash flows. And in my live webinar, that's one of the things we're going to be doing, is creating the statement of cash flows in Excel, and we have to write the formulas. The formulas themselves are very simple. It's addition and subtraction. But we have to understand which way to go in order to get the right reconciliation in terms of going from net income to cash on the statement of cash flows. We have to understand if accounts receivable increases, then I have to subtract that from net income. If accounts receivable decreases during the period, that means that during the period I collected more on receivables than what I invoiced. So the opposite happens. I have to add that difference back to net income in order to arrive at what I've got in the bank, because I've collected more than I invoiced. So it's important to get your head wrapped around these relationships so that you'll really understand what I'm covering when I go through how to build your statement of cash flows in the projections template using Microsoft Excel. It's all going to start here in QuickBooks, but then it's going to get exported, and we're going to write, like I said, simple addition and subtraction. You just have to understand at each section of the statement of cash flows, if we're dealing with an asset accounts change, or if we're dealing with a liability or an equity accounts change, then we have to understand which way to go. Do I subtract the current month from the prior month, or do I subtract the prior month from the current month in order to arrive at the right change so that I can get my reconciliation to balance when I'm trying to get from net income to cash at the end of the bank, to the cash balance at the end of the period, cash in the bank at the end of the period. That's good. I'm learning how to speak. That's what's good about me doing these screencasts. They help me learn how to speak. So if you have any questions, please email me, Seth@nerdenterprises.com. As always, I hope you found this helpful. If you didn't, watch the video again. You probably missed something. No, I'm kidding. But send me an email, Seth@nerdenterprises.com. Please, please, please come and sign up for my live webinar coming up on October 14th, 2011. If you are already past that date when you're watching this, then come to the events section, look for the cash flow projections event, and you'll have a link here where you can download the video of the live session, which is a 3-hour workshop on how to build your projected financial statements, how to build your cash flow projections, so that whether it's for yourself or for a client, you can look at the numbers and figure out, to the best of your ability, of course, and based on best estimates of what's going to happen, what you can expect your cash balance to be in the bank at the end of a year, or even at the end of 2 years, or however far out you feel is appropriate to project. And of course, you'll see in the live webinar, we have to revisit these numbers and this information monthly to make sure that we're on target, to make sure that we don't have to revise those projections. So I'm going to show you how all that works, how to do it, how to do the updates each month. Everything's going to be well covered. And the formula writing in Excel is not complex. Like I said, it's very simple. It's addition and subtraction. We might even get into some multiplication and division. So brush up on your math skills, sign up for the webinar, and send any questions you have to me at Seth@nerdenterprises.com. Thanks for watching. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.